All right, what gives? So Donald Trump basically tanked the market right into close because he started yapping about cooking oil. Same day that tariffs on upholstered furniture and kitchen cabinets and vanities start going into effect, pissing off a lot of real estate folks. Boy, we got to talk about the real estate crash. We'll talk about that towards the end of this video, but we need to understand, what are people doing? And let me give you a spoiler alert. People don't give a flying crap. Here's literally Bank of America's fund manager survey saying people are bipolar, and that's literally spelled B-U-Y, as in people don't care, they're just buying. So we're gonna talk about people not caring, cockroaches, and real estate. Yes, that's literally the itinerary for this video. Okay, so first, people not caring. Look, Donald Trump is like, China is taking advantage of us. They haven't bought a single one of our soybeans, and I want my beans to be bought. That's because, like, 31% of the crops we make in America are soybeans, and even if farmers go between wheat and soybeans one of the years, they're getting screwed over here. So a lot of farmers are suffering right now. Donald Trump promised them a bailout, sort of like he had to do in 2018 when basically China started buying soybeans from Brazil. Oh my gosh, it's almost like there's a pattern here, like history repeats itself. Oh, God save us if this is anything like the Smoot-Hawley tariffs. Anyway, understand, this isn't a surprise. Donald Trump said he would bail out the farmers like he did in 2018, except now he's blaming Democrats for not being able to bail them out because he engineered this government shutdown so he could cancel now over $28 billion of Democratic-funded projects, including massive solar farms in Nevada, which is crazy because at the same time as we're blowing up data center energy demands, increasing the cost of living for everyday Americans, we are now apparently, and we're trying to build out as quickly as possible more energy needs. Apparently we're like subsidizing the oil and natural gas and energy lobby here or something because green energy is just gonna get screwed. So while we need many more gigawatts, we just destroyed 7+ gigawatts in just one facility in Nevada, enough to power 2 million homes. Poof! Oh, sorry, we canceled that project because Democrats. Mind you, Donald Trump's also firing a bunch of people, mistakenly firing over 800 people from the CDC last week and then trying to rehire them. There's a lot to talk about here. But none of this seems to have people nervous whatsoever. In fact, it's like, frankly, the opposite, some of these numbers, in terms of nervousness, which I wonder if that alone should make people nervous. But nobody cares that Donald Trump is like, well, we're going to get the Chinese back. We're going to tariff their cooking oil. Because after all of what the Chinese send abroad with cooking oil, we buy over 41% of it, and we're tired of it. We're just not gonna have it. You know what? Americans are gonna start making cooking oil great again. Like, I don't even have the patience right now to do a good accent. Not that I could if I tried, but it's just exhausting. It's like, what? Anyway, all markets hear about this with the exception of obviously at the close because institutions at least or algos pretend to be risk averse. This is exactly what we saw with the Qs over the last couple days, where when you get Donald Trump saying something wonky, what do you end up getting? Oh, wow, what a surprise. You get that sell down towards the market on close. Look at that volume coming in at the close. Pretty frickin' wild. We'll have a lot to talk about tomorrow in the Meet Kevin Alpha report as usual. You already know about that. I'm not going to pitch it here. It's at meetkevin.com. You know the coupon code Schumer Siesta. What matters more is that right now, global recession concerns are at the lowest levels that we have seen in 3.5 years. Bond allocations are at the lowest level since October of 22. Even though the 2-year just dropped below 3.5, briefly the 10-year fell below 4% today, which that could be, with Powell's dovish U-turn, we could start seeing yields tank. It would actually be exactly what the Fed should be doing, by the way. Like, I think the Federal Reserve should be doing whatever they can to get rates lower because I actually agree with them that inflation from the tariffs will be present but will be mostly transitory, and then rates are going to plummet because they have to support the labor market. Even if only half of the labor market is suffering, it's still half of the country that they're going to have to support with their dual mandate in focus. Anyway, fund manager survey investor sentiment is the most bullish since February, basically before liberation, and stock allocation is now at 8-month highs, while at the same time we're at dangerously low levels of cash, and the only thing people are worried about is private credit, AI bubbles, and cockroaches. Yeah, the cockroaches comment comes from Jamie Dimon saying there's a possibility of more credit stress ahead, saying that when you see one cockroach, there are probably more, referring to the bankruptcies of Tricolor and First Brand Groups. Okay, we got to talk about that a little bit more. In addition to talking about gold and the future valuation of gold, the risks in the market, but towards the end of this video, we've got a lot to mention about real estate. Just a quick spoiler alert. Carrier was really freaking bullish in the second quarter. They're like, oh wow, we're kicking butt. Our, sales are up 3% year over year. What tariffs, yo? We're kicking butt. I guess they've never heard of something called a pull forward, because now they're like, oh crap, something hit the wall in September and October. And that's creating some concerns about the housing market. So we're gonna touch on the housing market. But a lot of you have been wondering, Kevin, is there a good portal I should be looking at for managing my tenants? And that's where I'd like to introduce you to Baselane.
Keeping track of your rental finances shouldn't be stressful. In fact, you should just be able to automatically collect rent and automatically start earning a yield on the cash in your account. And that's where Baselane, today's sponsor, comes in. But remember this, juggling rent payments, expense tracking, and tax prep across a bunch of apps and spreadsheets, pain in the butt. You don't want to do that. It's a full-time job on its own. And that's why today's sponsor, Baselane, exists. See, it's built specifically for real estate investors who want a simpler way to manage their rental properties all in one place. With Baselane, you can open unlimited checking and savings accounts for each property with no monthly maintenance fees, no hidden charges, no minimum balances. Everything is built with real estate investors in mind. So that way you can separate income, reserves, security deposits, and expenses without all the manual work. Rent collection is also fully automated. Tenants get reminders, late fees, if necessary, can be charged automatically, and payments are deposited directly into your account in as little as 2 business days. Which is awesome, because some platforms will make you wait like a week to 10 days to get your money, which is nuts. And when tax season hits, Baselane gives you clean, categorized transactions and downloadable reports, making filing way less painful. So sign up for Baselane at baselane.com/Kevin. Get a $100 cash bonus when you fund your account. That's baselane.com/Kevin, or click the link in the description down below and you get $100 just for funding your account. Keep in mind, Baselane is a financial technology company, not a bank. Therefore, banking services are provided by Thread Bank, member FDIC.
And yes, there are some concerns when it comes to housing. Here is that update from Carrier. Carrier said this week that volumes in the residential business would be 40% below last year's level, a much weaker rate of demand than the company forecast only 6 weeks ago. So in other words, 6 weeks ago, they're like, everything's fine, everything's great. They're basically like contributing to this GDP estimate of like, oh, everything's wonderful. And now all of a sudden they're like, oh my gosh, we're gonna have to 8K this, which is like an SEC update, because our numbers are gonna be way worse than we thought. So all of a sudden they hit a wall. Oh my gosh, what a surprise. You mean tariffs could eventually have an impact? No. But anyway, we saw a similar 33% plunge in US air conditioner shipments in July, 18% drop in deliveries of heat pumps, suggesting the trend isn't just limited to Carrier, although Carrier is trying to offset that with their installations into data centers. New single-family home sales are expected to decline by low to mid-single digits this year. Mind you, this whole real estate issue, which if we go to the Bank of America Fund Manager survey, is very reminiscent of what we saw in the early 80s. We didn't actually see a housing price crash. What we saw was a volume collapse. Housing volumes fell. And so if you look at institutional allocation amongst fund managers to real estate, it's low. I even wrote LOL on it. Net asset managers who say they're overweight real estate, it's at here, what is this? Fund FMS real estate allocation is net 12% underweight. Net 12% underweight. Current allocation is 0.7 standard deviations below long-term average. So we're below long-term average, though we're still not quite negative like we were after the bubble pop in 2008, though this is really a different bubble. Not to say that this is different. It's a bubble. Let's be clear. We are in a euphoric mania. But it's sort of like the crash that caused, the double dip recession in the early 80s was an inflation shock of the mid 70s, which somewhat you could argue we've had an inflation shock now. The crash of the dot-com era was obviously excessive valuations in AI. Today, people are like, we can justify, no worries. Of course, fund managers are still worried about a private credit event in an AI bubble. Jamie Dimon, by the way, was the cockroach guy. He's like, I'm not trying to call him a cockroach, though I'd love to because I hate the bank. I used to like them a lot, but I'm like, man, you guys don't, you're so behind on your technology, dude. I tried, it's kind of like you're dating and then you're like, man, they treat me like crap. And then all of a sudden you date somebody else and you're like, oh my gosh, there are people like this out there? Banking. But anyway, Jamie Dimon, he's like, the credit event that we saw with Tricolor, if there's one cockroach, there are more. I mean, we already touched on this. But why does that matter? It matters because the focus of where concerns on risk and valuations are today are really AI, the cockroaches of private credit, which encompasses, mind you, debt not only of investors, but also of buy now, pay later. Buy now, pay later is a huge bubble. The New York Times Magazine just had a great piece on buy now, pay later about how people are just basically leasing a lifestyle. And eventually you're going to run out of the ability to keep leasing that lifestyle. But volumes are collapsing in real estate housing activity, not prices. And one of the ways I like looking at this and sort of monitoring this is seeing what's going on the Redfin Data Center. If we jump to the Redfin Data Center, yes, broadly, when you get these news headlines, we're like, oh my gosh, what's happening with housing? There are problems with these issues in terms of volumes. But you look at actual median sales prices, of course, every year you have an up and down. You have the May bump. Every single year you have that May-June bump. Duh, it's buying season. But 2025 is still well above 24 by 4%, well above 23 by another 2%. Actually, that's probably even more. You could look at the chart yourself. You get it. And then obviously you could get sort of macro in this if you want. You could go into San Diego where 2025 is somewhat converged but slightly above what you've got in 2024. You could go into New York City and you go into New York. You could see New York also somewhat converging with 2024, but still above, right? So broadly, nothing really to see here in the real estate market. Okay, so what about even Miami? It's fine. Again, volumes, problematic. All the other stuff, it's not that bad. I think that's why Goldman is like, hey, we're putting the housing market on a 4. So they have this little scale where they put where the housing market is, and they say that over 50 years, we've determined that a reading of 5 is in line with historic norms, and 0 represents the weakest market outside of the financial crisis, and that was in 1982, and it was even weaker than it is today, even though that was just a volume correction, and real estate prices were mostly flat. That's how bad it got in 82, was flat. Not as the financial crisis where these numbers were probably negative. But anyway, they see the market right now as broadly in line with longer term averages for real estate, which is interesting. So then where are people throwing their money? Well, if you look at the fund manager survey, people are throwing their money, first of all, on the belief that we're going to get a Chris Waller. If you actually look at Kalshi, though, the betting markets say that Hassett has a greater chance. I think that's because fund managers and economists want Waller. Nick T posted that. And then Hassett is wanted by Trump because Hassett's, let's be clear, he's just a shill. We don't even have to go deeper into that. We talked about that in the Fed meeting video. But anyway, scroll up here for a moment. Let's look at some of these other charts. Expectations for higher bond yields have risen to the highest level since June of 22. This to me is crazy because Powell is literally talking about turning the vacuum cleaner off and no longer selling bonds, which would be huge for the bond market. I actually think we might have a breakout on bonds the moment we get this double set of jobs data. September, October, you could potentially see TLT rocket over 100 or over 110 or whatever because people are going to go, oh crap. We'll see. Or we'll confirm a soft landing, right? That's we don't know. Anyway, individual productivity. So 52% of fund managers say AI productivity is already happening. I think it's individual productivity that's happening, not sort of corporate revenue. Talked about that in the last video as well. And then over here, you can see recession expectations are the lowest since 2022, which either puts us in 2007 and totally blind for what's about to happen, or 2014 or 22, and we're really just about to take off with valuations and the market. The only thing that really makes me nervous out of all of this is right here. Fund manager average cash levels declined from 3.9 to 3.8%. The sell signal for Bank of America was triggered in July, and the hard sell comes at 3.7. So we are on the, we're knocking on the door of a hard sell from Bank of America. Now, this also comes at the same time as the International Monetary Fund is like, hey, there's some crazy stuff going on right now, and if we look at just broadly, we might actually end up having some problems here. Look at this. Global markets are too comfortable with risks, including trade wars, geopolitical tensions, and yawning government deficits, which combined with already overpriced assets increase the chance of a disorderly market correction. This comes at the same time as people are now writing articles like, this is the dumbest stock market in history. And they're basically bagging on passive market investors because the only thing people are doing to do their fundamental research is they're, basically looking at the chart, and if it goes up, they buy. And since a lot of passive funds are going up, they are getting bought hook, line, and sinker. Now, is this problematic? And where is my head on all of this? Well, I'm going to tell you. I've been mid-range on the bull-bear scale. I really, really, really want this job data, but I'm grateful to see the Fed is already preempting some of it. I'm gonna play videos of the kids while I talk about this. Because it's me talking, you're gonna get to see Max, you're gonna see some babies here, and I'm really excited about that. But anyway, so look, here's the thing. I want us to confirm a soft landing because I believe that is going to be best for all Americans. All Americans will be able to reinvest into more stocks, into real estate, into HouseHack AI. I want HouseHack AI to go to the moon. If we have a recession, that might get delayed a little bit. Like, we'll be fine because we're pretty much a cash operating company and we'll just buy the dip on a lot of houses. But if I had a bias, I want this soft landing this thing. And I'm really grateful that Jerome Powell is waking up to the risks. This pivot today was critical. Remember, I don't know if you remember, but the last Fed meeting we had, I'm like, bro, please go dovish. I didn't think he would. We talked about if he ends up going dovish, we're going to be under 4% on the 10-year yield. But if he goes neutral, we're going 4.15. And it's literally exactly what happened. The statement was dovish. We go under 4%, tested, fact-checked what Kevin predicted. Then boom, we go to 4.15 after because he ends up going neutral. It's what we predicted in the Meet Kevin Alpha report. Remember, you get those every time we have events like this. You get lifetime access to it. So you buy it once and you just keep getting it, which is great. But understand that this U-turn, the markets aren't going to appreciate, but it's very bullish. This is what the Fed should do to support a weakening labor market. And I couldn't be more grateful to hear that the Fed is finally waking up to realizing, listen, if we take out tariffs, there's basically no inflation. And so we're going to focus on the labor market. This is a very bullish U-turn. So while it's also concerning because it's like, are we already too late, which would be the bearish side, it is bullish from the Fed because it means they're acting. And then the question is just, will their actions be enough? That's always the question. Is it actually going to be enough, or are they going to have to run that money printer really hot, just like they did or have every single time in the past to actually mark a real bottom? And in which case, what are we going to go through before that happens? I mean, you openly have Morgan Stanley saying, yeah, right now a correction would actually be healthy. And mind you, a lot of people are really, really pumping gold. In fact, I forgot to mention that, but gold valuations, obviously, off the charts right now. Net percentage of fund managers saying gold is overvalued, now at 41%, up from 24%, and is now considered the most crowded trade, followed by the Mag 7 and short dollar trade, and then long crypto. So gold, as far as fund managers, only a 2.4% position, but that's now considered the most crowded trade. So kind of wild update, but anyway, this gives you a little bit more color. So bullish on the Fed action. I just hope it's not too late. But this is exactly what we need to keep, whether you call it the bubble or the economy or the boom going, is a soft Fed. Hasset will actually be perfect for shilling it. So in fairness, it's probably bullish to get a Hasset.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.